Hello and welcome to my morning note. Well, we're risk off again today after what appears to have been a brief risk on interlude. We've seen stocks fall quite badly in the States and subsequently in Asia and Europe. There is the very specific news out of Moody's that it's downgrading a large number of international banks, which has obviously caused some concern. But beyond that, we've also seen very weak economic data from a number of regions. Perhaps what's most interesting is that even while stocks were rallying, oil was still falling. The Brent contract is down more than 30% from its high for the year. And also the Brics, Brazil, Russia, India and China, are falling. They're supposed to provide some kind of a hedge on the developed world, but that has not been the case of late. What's going on? Let's talk about it with my guest today. He's our investment editor, better known for the FT Short View, James McIntosh. James, thanks for making a Friday appearance. Let's take a look at this chart, which looks a little bit like spaghetti. These are from data stream indices, and you can see that the US has done really quite well since the beginning of last year, and then we see the Brics tangling in with the Eurozone. What's going on?
Well, this is just the atrocious performance of the Brics, really, since the crisis began, and even from before the crisis began. There is a little bit more going on than just the crisis, but a large part of this is, of course, that emerging markets in general are a high beta version of Western markets, so they tend to accentuate the performance of whatever you get in the West. So when Europe's falling, you get a bigger fall in emerging markets because people suck out their money. They want to go for safety, and frankly, Russia or China doesn't feel to them like the safest place to be, even if the crisis is actually in Europe.
Now, are we seeing some weakening of that trend, however? You had a very nice long rally in American stocks, and okay, there's an early bounce there in the Brics, but
absolutely. In fact, things have been much worse for the Brics this time. So they fell about twice as far as the wider European indices from the sort of point of the crisis really hitting here. And then in this recent rally that we've had in so far in June, excluding yesterday, I should say, it may well be over, but in the rally we had so far in June, they recovered on average less than the Europeans did. So they're not showing that high beta on the way up, they are showing it on the way down. They're falling faster, but they're recovering less. And there are some good specific reasons for this.
Okay, now there's one interesting part of the puzzle is that there has usually been a correlation between commodities and emerging markets. Let's take a look at the oil price. This is the WTI contract. It would look much more impressive if we use Brent. And then comparing that with China and Russia, we've had this remarkable sell-off. Why is it having the kind of effect that it's having on Russia and China?
Well, Russia in particular is basically a play on the oil price. So the Russian budget is now looking rather strained, which is another good reason to worry about Russia. Their break-even, to make their budget balance, they need an oil price of about $117, and that's on Brent rather than WTI. The oil price
so
now...
they need a 20% or so rise from where we are now to get back to break-even.
Now, maybe we'll see that, but it doesn't feel like that's where oil's going at the moment, and certainly we've seen some pretty bad knock-on impacts from that for Russian finances. Now, of course, Russia is not in a sort of the panic state that we saw back in 1998 when it defaulted. It's a fairly solid currency from a country from a financial perspective, but still, this is worrisome. They may have to have some cuts. At the very least, they're in a less strong position than they were, which is bad news.
Now, what about China, though? I mean, China buys oil. It's supposed to benefit from a low oil price.
Well, China is probably not just here about oil, because actually, in a sense, China is part of the cause of the falling oil price. So China's been slowing very rapidly, and that's had knock-on effects across the whole commodity space. Industrial metals in particular, where China really is the big buyer, have been plunging. And oil is part of that. Because China's a big buyer of oil, but really it's a sort of secondary impact. So Russia suffers from this. China sort of benefits from a falling oil price as it does from falling price in industrial metals, but mostly the prices fall because China's doing badly rather than China doing well because the prices have fallen, if you see what I mean.
I do indeed. James, thank you very much indeed. I think what we need to bear in mind here is that China continues to be much more important than many of us realise. Perhaps it's very difficult given how exciting the Eurozone is at the moment. We should all be paying as much attention as we can to China.